Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planner, owner of Shepherd Wealth Management. Very excited today to be back in the home studios here. Ezra, hope you had a wonderful week thus far. We got a lot of cool things to talk about today. Anything on top of your mind before we get going?
No, it's been a good week. I'm excited to dive into it, get that big data energy kicking.
Plenty of that today.
How was the beach, though, real quick, before we go? It's good to see you again, you know?
Yeah, absolutely. It's a great week. Got to spend time with the family. Took the daughter down to Grandma and Grandpa's in Florida, where they're now retired and enjoying the retirement life. She's getting ready to start school tomorrow.
Oh,
so that's awesome. That's why we took her down there. So it was a good time. Fortunately, I was able to work down there as well. A lot of good things happening in the market that we're going to be talking about today. So we want to be able to get in front of some of that for clients. So I'm very excited to be back here in Florence, Kentucky, y'all.
Yeah.
And we're gonna do this thing today. I know we got a ton of data, a lot of really interesting things that are coming around the corner. Of things we want to be able to do for the community here at Shepherd Wealth Management. Right. So a lot of very, very fun and exciting things to talk about. Some serious stuff too. So we'll have some fun today along the way as well. And I know we'll have some viewer questions that we'll want to answer today.
Yeah, text lines are open, so I'm sure they're going to be pouring in as soon as we get, especially once we dive into some of this stuff. So.
Yeah, please do 513-630-2664 if you have those questions. We'd love to answer them for you right here live on the show. So most important data that I think everyone in the stock market, participants in the market around the world are looking at inflation data, primarily here in the United States, but they're looking at that inflation data all across the globe because pretty much not every central bank, but most central banks around the globe are tightening, meaning they're increasing interest rates to slow down the inflation pressures that we're seeing here. And obviously we want to be able to slow down some demand as well. To bring those numbers down. And that's exactly what we saw. So what kind of led this rally that we're seeing here over the last 4 weeks, because we've had 4 consecutive weeks, the S&P 500, the NASDAQ, the Dow, pretty much all the major averages having positive weeks for 4 consecutive weeks, which is very much welcomed after 6 straight months. It felt like of just downward declines.
Yeah, it feels like I got a couple days at the beach after seeing those numbers.
So, it's not like we're out of the woods here yet, right?
Obviously.
And the reason why we do this show is just for maybe the folks that are tuning in for the first time. We do this show because I know all of my clients are just like me. They're human beings. We're all hardwired with these emotions called fear and greed. And the news does a really good job of playing into that. That is their job, and they do it well.
Yeah, and it's just frustrating, though, when you see 2 or 3 data points, they want to start throwing a trend down your throat, Well,
that's just it. That's their job, is to keep eyeballs on the screen.
Right.
That's how they make money, right?
Yeah.
That's how they sell ads, and they do it really, really well. And that's the reason why we do this show, is to say, yes, these things are happening, right? 40-year high inflation, supply chain issues, geopolitical events going on over in Ukraine. Yes, all these things are happening. But there's a whole lot of history and historical context that similar events like this have happened in the past, and we can learn from those events. I tell clients in the most recent newsletter I send, so I send out a monthly newsletter every month to my clients, and I always try to fit in a Warren Buffett quote, right? For those who've been following the show, I'm a huge Warren Buffett fan.
Huge. He's our spirit animal.
It's hard not to love the man for a lot of reasons, but from strictly performance, he's two times better than the S&P 500 since he took over Berkshire. I think it was 1963.
Right.
Anyway, what Warren Buffett had to say about human beings is that human beings tend to not learn from history. And that's why we do this show. So yeah, these things are happening. Here's what history has to say during similar times, and here's how we can kind of position ourselves. So that's why we do this show, and that's why I really enjoy having these conversations with you live here and answering viewer questions. And I know my clients love it. They've given us nothing but really excellent feedback. So if you like the show, please subscribe to us on YouTube. Check us out on Spotify as well. We put the audio on there after we do these. And Friday happy hours, right around 4:15, right?
Yeah, we're getting a lot of positive feedback for those. For those of you that are listening, either live right now or finding this later on the YouTube, we do a live happy hour pretty much every Friday, about 4:15, right when the market closes. Joshua runs down all the data for that week, just kind of going over, basically with a little bit of hindsight, little Monday morning quarterbacking, just seeing how the market did and why it did the things it did that week. You can pop in the chat live, ask questions. It's kind of like open office hours for Joshua as well.
Yeah.
But then we've started archiving all those on the YouTube as well. So you can go back and watch them, which I think, we get a little while down the road. Those are going to be great just to kind of see, as more data points to compare for how did things go this time last year?
I've been talking about it all year long. Like, I think we're going to start to see a real recovery. I know we're getting a little bit of that right now, which is very much welcome. Don't get me wrong. But I think we're starting to start to see a real significant recovery sometime this fall, right around October. I've been saying that all year long. We'll see what actually happens. That's what history would have to say about that. But it'd be great to be able to kind of look back on this, months later, just to see what actually really did happen.
Yeah, we got that right.
Maybe I might have that. I might have egg on my face with I might want to delete that from social media.
That's all good. That's all good. That's the thing about the market is, it's never 100% guaranteed, but we can do our best to prepare ourselves.
For sure. And I know I'm supposed to tell everybody that, I talk about history and historical context. Yes, I have to say as a fiduciary, this is for all the regulators out there. Past performance is no guarantee of future results. That's been said ad nauseum forever.
Yeah. Well, it's good to keep in mind.
It is. It's not a guarantee that this is going to lay out perfectly, but generally speaking, if you're a long-term investor and you look at the historical trends of similar events, history tends to repeat itself, which is why they kind of force us to take history every year.
Yeah.
Throughout the school process. But getting back to the data here, inflation came down a little bit. The last reading was at 9.1, which was way hotter than what economists had expected. With the last reading came down to 8.5. Still very, very high, relatively speaking. Not anywhere close to where the Fed would like it to be, near 2 to 3%. But that's the reason why we started to see a little bit of rally. It kind of gives the Fed wiggle room for the soft landing that everybody's been talking about all year long. So we've done a whole bunch of interest rate increases. We came into the year only really expecting one or two, 25 basis point increases. We've had 2 consecutive 75 basis point increases on the back of increases that they made earlier in the year. And now we're coming into September where we're probably going to see the Fed do another 50 basis points instead of doing 75. And the reason why they're cutting down from 75 to 50 is because inflation has come down a little bit. But not enough for them to take the foot off the gas, so to speak.
Right.
And that's why we're starting to see a little bit of this rally. Interest rates came down a little bit because of that. So we'll see what actually happens. That's a good sign. Hopefully we'll continue to see inflation come down a little bit, and that's obviously going to leave a nice runway here for the equity markets, no doubt.
Right.
We also have some cool news regarding chips. So President Biden did sign the chip law. It's $280 billion tech spend package, and $52.7 billion of that is earmarked for expanding chip making. So obviously, this has been in the headline news for a couple of years now, essentially since the pandemic has come about. And I think a lot of well-developed countries are looking at things, and we talked about this all year long, is that they really need to be energy independent, agriculturally independent, and be able to produce chips and have the independency there.
Right.
So I think that was a significant piece of law that just got signed, and I think it's going to be very, very important for the future of the U.S. economy to be able to compete, with competitors around the world like China and all the other places that are already doing most of the manufacturing of that product right now. So that's some good news as well. And of course, we're right in earnings season. Some awesome numbers here. Some August Dow Jones leaders. We're going to talk about some of these earnings here in just a second. But in August, we saw Disney pop 16%, Home Depot popped 8%, Apple up 7%, Procter & Gamble up 7% as well, with American Express also jumping 6%. And we're right in the middle of earnings season, so I wanted to share some of that information with everybody that's out there. And why do we do this? Is because earnings matter. And so far this year, leading up to this earnings season, earnings really haven't mattered all that much, even though they've been very strong. A very healthy percentage of the S&P 500 companies have met or exceeded analyst expectations all year long. It's just that nobody seemed to care earlier in the year because we had historically high inflation and we didn't really know, how the Fed would be able to engineer a soft landing. They have a terrible track record of doing that, so it caused a ton of sell-offs, a spike in interest rates, and obviously a whole lot of selling in equity markets. But with the earnings that we're seeing now, we're getting better comparisons from a year ago. Right. So the comparisons are a little easier to make. And we've also had CEOs and CFOs on prior earnings calls saying, yeah, we are seeing, issues and headwinds with supply chains, although it's getting a little bit better. And we're also seeing issues with, inflation, fuel cost, et cetera, that are hurting our profit margins. So they kind of brought back some of the guidance in Q1 and Q2. But now that we're in Q3 here for earnings, looking back on prior results, CEOs and CFOs are saying, hey, actually supply chain is getting much better than what we had thought. It's still not fixed completely yet. And yeah, we still have the higher fuel cost and these inflation pressures, but they've been able to do a really nice job of engineering some excellent results in the face of all these headwinds. And I've talked about this ad nauseum, and I always will. Betting against the U.S. corporate economy for the last 240, 250 years was a terrible bet. Terrible bet to make. And time in the market is so much better than trying to time the market, because some of the best days that you're going to see come right on the heels of some of the absolute most volatile and terrible drawdowns that we see.
Yeah.
And that's exactly kind of what we've experienced thus far with the S&P 500 basically retracing 50% of the losses that it's had so far year to date. It's still down 10%, but it's a heck of a lot better than being down 20. No doubt about that. So I wanted to kick this off here, and we want to get to a bigger conversation about the rally that we've seen.
Okay.
But I just want to kind of cover some really, really interesting numbers here from a performance standpoint for some of these major corporations. So we just saw some recent earnings announcements from a major retailer, Walmart and Target, as well as Home Depot. Walmart had excellent earnings. They had earnings per share of $1.77. Analysts were expecting $1.63 on sales or revenue for Walmart in the quarter of $152.9 billion in one quarter. Wrap your mind around that. I mean, there's some sovereign countries that can't produce that much revenue and GDP in a year, and they did that in one quarter. And analysts were expecting $150.9 billion, so they significantly outperformed on the sales side. 1 year ago, Walmart posted earnings per share of $1.78 on 141 billion sales. So sales actually were up about 5% from the prior year. And the reason why their earnings per share is about the same as what it was a year ago, even though revenue was substantially higher than what it was a year ago, has everything to do with inflation, right? The cost of food, the cost of fuel, the cost of employees, all that has impacted the numbers for not just Walmart, but for pretty much everybody. They did maintain their guidance for the remainder of 2022. They had to sell a lot of inventory at a discount. We're going to talk about Target here. They had to do the exact same sort of thing to get a lot of that inventory glut, out of their facilities, which also hurt their profit margins. And really what the CEO and CFO had to say for Walmart's corporate earnings, which is very similar to what Target had to say, is that consumers are feeling the pinch of inflation. So they're kind of focusing on the basics, right? The food primarily, which is a much lower profit margin for those types of companies, Walmart, Target, as opposed to consumers spending more money on apparel, clothing, things of that nature, which has a much higher profit margin. So they've had to shift the way they go about managing their inventories. And quite frankly, it just really took them, a quarter or two to kind of figure some of this stuff out, which you got to give them a little bit of grace coming off the heels of a global pandemic and, war going on in Ukraine, which, increases prices substantially for all these items that they're selling in their stores. But now they're starting to get their arms around it. And the fact that they're maintaining guidance for the rest of the year, I think is encouraging, because they had all the reasons in the world to say, hey, I don't know what's going to happen over the next 6 months here because of all these issues that we've been trying to figure out all year long. And a lot of corporations will do that, to do what I call sandbagging, where they kind of lower the bar. Yeah, so I don't think we're going to do all that great, and all of a sudden they come out with quarterly results that are way above what analysts had expected. Because of that guidance, now the stock pops.
Right.
So the fact that they're saying, I think we can, reasonably expect that the rest of the year to go as planned, that's very, very encouraging for me, because they had all the reasons in the world to kind of lower the bar for themselves for the next quarterly announcement.
Right.
So Home Depot really crushed it. Huge Home Depot fan. Earnings per share of over $5 versus $4.95, what analysts expected. On sales of $43.8 billion, they were expecting $43.4 billion. So sales were up 6.5% from a year prior, and they delivered. So Home Depot delivered the highest quarterly earnings per share as well as revenue in any quarter in the company's history. And the average ticket price, so if you go into Home Depot and you purchase, items, whatever, that's what they're calling a ticket, rose 9.1%. So customers' transactions fell. So they only had 467 million transactions in Q2 versus 481 million a year prior. But again, because the ticket went up by 9.1%, again, inflation, lumber cost, et cetera, that's the reason why they had the best quarter that they've ever had from a earnings per share and revenue growth. Now, that's obviously not sustainable because we do not want inflation to be at 8+%, indefinitely. That's not going to happen.
Right.
But the fact of the matter is that they were able to protect their margins, their profits, even though they had fewer transactions. What does that mean? They have pricing power. Right. And that's really what's important throughout this year from a individual stock performance standpoint is what are the companies that can deliver in the face of all these headwinds. And Home Depot has done an excellent job of doing that. Whereas Walmart and Target and others have had to have a couple quarters worth of dealing with these issues to now be able to put themselves in a position to probably do well for the remainder of the year. Yeah. Apple earnings, absolutely awesome. Earnings per share, $1.20 versus $1.16. Sales of $83 billion in one quarter versus $82 billion, which is what analysts expected. And the gross margin is really the big story here for Apple because they didn't crush it on every single product line that they sell or every service that they offer, but their gross margin was 43.26% versus 42.61%. So their margins actually grew in the face of all these headwinds. So again, excellent leadership there from Tim Cook and his team being able to deliver these types of results in the face of all these headwinds. Again, I go back to it. We can all get extremely emotional when we go through these events, which are inevitable, by the way. If you're a long-term investor, 26 bear markets, there's been 27 bull markets. I have a hard time when a prospect or just somebody in the street, starts getting into the rabbit hole of all the issues that are going on, right? These CEOs, they see all these issues way before we all do.
Yeah.
And they're responsible for, in some cases, millions of individuals' lives, how they support their families and obviously customers around the world. And I get it. It's easy to get in that rabbit hole of gloom and doom. And this is, different this time than it ever has been in the history of things. But if you were to bet against the market for the last 250 years, it was an absolutely terrible bet. And like we've talked about all year long, I mean, the world only ends one time. And if you bet on that, even if you're right, you're not going to collect from anybody. So, and it just simply won't matter if you have no money or all the money in the world. At the end of the world, you're not going to be buying iPhones. That's not going to happen.
Probably not. No.
So, getting back to the earnings here, wrapping that up. Amazon posted excellent numbers, even though their earnings per share was actually a loss of 20 cents. Their sales rose 121.23 billion in one quarter versus analyst expectations of 119 billion. The big one, though, two big ones. So revenue did grow by 7% in the quarter. And AWS, which is their cloud business, 19.7 billion in sales versus 19.5 billion expected. That's a 33% increase in sales from a year earlier. Wow. Just from that one business. I mean, that's basically where all of their profit is coming from. And there really has been no recession in the cloud business so far this year. I mean, Microsoft posted excellent earnings with Azure. And then, of course, Google also did really, really well with their cloud as well. And the other big one for Amazon was advertising. So advertising sales were 8.76 billion. Analysts were expecting 8.65 billion. So in the face of a lot of headwinds, right, where everybody's worried about a recession, the immediate thing that CEOs can cut is their ad spend, right, their marketing spend. What they decided to do is cut it from places like Meta or Facebook and Snapchat and other, platforms, social media platforms, and they shifted it over to, looks like primarily Amazon, Google, and a couple others. And most recent earnings announcement was Disney. This was really cool for all Disney shareholders. We are Disney shareholders here at Shepherd Wealth Management, at least for the majority of clients, not everyone. But they've had a substantial growth in their subscriptions for Disney Plus, 152.1 million versus 147 million, which is what analysts had expected. And they have over 221 million subscribers if you include Hulu, ESPN Plus, and Disney Plus, which is a package what most people are going to go with. That's what we have in our house with young kids.
That too. I'm a bundle.
Yeah, I'm a bundle guy. I like Star Wars. I like Hulu and all that stuff.
Cannot get enough Star Wars.
Star Wars rock, and all the Mandalorian stuff is great.
Oh, yeah.
Obi-Wan Kenobi's cool. I mean, we can get a rabbit hole on this conversation.
We can, and we'll just end with the fact that I love that he basically kicked Vader's butt a second time in that show.
He did.
Awesome.
But here's the cool part. So the whole goal of Disney Plus, and this is where it's hard to evaluate the price of Disney shares, is because I think a lot of investors want to just look at the Disney Plus subscription growth, kind of like a Netflix.
Right.
The difference is Disney is not a one-trick pony. They don't just do streaming. They have a huge franchise and parks, cruises. I mean, we're going to get into that number in a second. But if you bundle, the Hulu subscribers with the ESPN Plus subscribers, Disney Plus, there are currently 221 million subscribers. Netflix has 220 million, right? But here's the kicker of why you cannot just look at Disney's subscription growth numbers, although those are important. What they actually were seeing at the parks saw a 72% increase, $7.4 billion in the quarter. That was up from $4.3 billion a year prior. That's a huge amount of growth. And by the way, the demand has not slowed for these increases in ticket prices for Disney parks or the cruises, because they're dealing with inflation too. They raise ticket prices pretty much for everything, including the food and everything else that goes on in there. They still have so much demand that they have to turn people away because there's just not enough space, right? They just simply cannot get a reservation. So that's what really is intriguing to me about how I go evaluating companies, because there's all kinds of companies that we can compare to Disney potentially, but nobody can touch their franchises, their parks, the cruises, and all the other things that they have. Just like
mention their retail. I mean,
exactly. And you can say the same thing about Apple. It's not just a hardware product, right? They have other services that they offer as well. Amazon, they offer more than just buying things on their e-commerce. They have a cloud business. They're in the healthcare. They're in all kinds of other things.
Yeah.
Google, Microsoft. I can go on and on. Berkshire Hathaway. All these companies have found a way to diversify themselves, and that's really what I think we're learning as Americans in this country, as well as citizens around the world, is that as a country we need to be diversified. We can't just depend on other allies for goods, for services, for talent. We have to be able to diversify in and amongst ourselves. So that's what these corporate companies have done a great job of, and I think governments around the world are starting to learn a little bit from that, even though you'll still have a lot of politicians going after some of these big name companies and calling them, not so attractive names, and they're very greedy and all this other stuff. But to me, it's just a smart way to go about building a business, to be able to generate income flows from multiple different industries, that way you're not just relying on one.
Exactly. I mean, you're seeing the negative of that with a little bit with Netflix now. I mean, they, like you said, were kind of a one-trick pony with the streaming, had a niche. I mean, I remember back in just not that long ago, you had basically Netflix and Hulu. That was it, right?
Right.
Netflix tried to broaden themselves out to be not only a production company, but also somebody who does, IP and original content. And they unfortunately didn't make very good decisions with how they branched themselves out, overextended themselves, which is why you're seeing a success and a rise in Hulu, versus Netflix kind of plummeting and making announcements that are scaring off some of their subscribers. Like, we're going to start having ads and all these things. And you talk about this on the show all the time about how, I mean, even when we had legendary coach and mentor Raj Gupta on here, how inflation gets passed on to the consumer. And you're seeing a parallel with that with Netflix. All these bad business decisions they made, they overextended themselves as what they tried to be a production company. And that's getting pushed on to their subscribers now with pulling on ads, ratcheting down on multiple households, sharing passwords. And it's because Netflix saw the need to diversify, but made very bad decisions when they did it.
Yeah, I think, I mean, just to sum it up, I mean, like, I like watching, the Ozarks and all these other shows on Netflix, right? What's the main character's name? The actual actor, Jason Bateman. There are no Jason Bateman theme park rides or, cruises or whatever, right? But there are all of those things at Disney, and they've been around a long time. They keep bringing out new content. It is a beast in and among itself. Before they started doing streaming, now, in my opinion, I mean, I know people will have a political light on Disney as well, and that's a completely different conversation. Sure. We're just talking about the economics of the business model itself.
Yeah, you're not advocating for the other stuff.
Correct. This is very, very strong business model, and when you compare it to a company like a Netflix, to me, it's you can't even make the comparison because they only do one portion, of what Disney does, and it's not even the most important part of their economics on their balance sheet and income statement.
Yeah, I mean, for every awesome, well, we could go down a Netflix hole because it kind of chaps my butt a little bit. But we'll move on. Let's move on.
So we got some really cool data. This is kind of the main topic. I know we just rattled off some earnings there because we're right in the middle of earnings season, and that's really kind of the focal point, at least right now, until we get to the next Fed meeting. However, we got some extra data here today. So this data is coming from Sentiment Trader, subscription that we pay for here at Shepherd Wealth Management. The S&P 500 winning streak above its 10-day moving average is triggering a buy signal from a technical standpoint. So this is more of a technical analysis. After similar streaks, the S&P 500 rallied 78% of the time over the next 12 months. And after a 20% decline, which obviously we've seen, the S&P 500 rallied 94% of the time over the next 12 months. And before we even get into more specifics on the S&P, the tech sector itself, the tech sector has come off. It's come up 20% off the 52-week low, and that rally took 40 days. Now that seems like a really fast rally, but it's not relative to history. Again, we got to look at history in historical context and comparing to what's going on right now. Since 1926, the tech sector has enjoyed 34 rallies of 20%. Gains off a 52-week low, and it took a median of 21 days for that to happen. This time it took 40. So the longer that rally takes, historically speaking, the longer the rally tends to last. So that's kind of something that I hope to look forward to. As I mentioned, when I was actually visiting my family down in Florida, we did a whole bunch of trades and added 2 tech positions. We didn't time it just perfectly to benefit from all the 4 weeks of gains, but we certainly got in front of a lot of that. And kind of expect that to continue because of the historical data that we're looking at here. And when we talk about the S&P 500, kind of coming back to that, what is this model kind of based on, this technical analysis? So we're looking at the win streak model, what they call a win streak model here at Sentiment Trader. It identifies a period whereby the S&P 500 closes below its 10-day average for a minimum of 12 consecutive sessions, i.e. an oversold type of market condition. And once that condition is achieved, the model will trigger a buy signal when the index sustains itself above the 10-day moving average for 21 successive sessions. And the win streak model has actually generated a signal 78 other times over the past 95 years. And after the others, the S&P 500 future returns, win rate, Z-scores were excellent across all time frames. So from a technical standpoint, we can kind of look at this and, it's not a guarantee that we're going to see further gains throughout the remainder of this year or even the next couple weeks as we wrap up the month of August. But history is giving us a kind of a green light here to start to add 2 positions in a portfolio. Whether you're indexing or using individual positions, I would kind of look at any, significant pullback that we might experience on any one day between now and the rest of the year as an opportunity to continue to potentially add to positions that you already own if you have some dry powder, or you can simply begin to look at rebalancing some things. So we'll talk about the energy sector here in just a second. Really, that's been the primary driver of performance in the S&P 500, even though it's one of the smallest sectors from a percentage standpoint. Energy is really the only meaningful sector in the S&P that's positive this year, being up 39%. And yeah, you could say utilities are up 7.8%, but if you got inflation at 8.5%, the real return, you could look at that as actually being negative. So energy's been the bright spot. Without a doubt. And because we've had that exposure all year long, or pretty much all year long for clients, that is a space that we'll look to rebalance out of. Maybe not completely. I do think that we'll probably see elevated natural gas and oil prices for the remainder of this year. But because we have the gains there, we can take some of that off the table and allocate that to positions in the S&P 500 or specifically the tech sector, which has had the biggest pullback so far year to date. So that's kind of the initial data points that we wanted to share here, as I know we got some questions coming in here today.
Energy. Yeah, we actually did. We just had a couple come through.
Let's go ahead and get to those here.
Let's see. All right. Yeah, I think we got time for a couple. So Kat in New Haven, Connecticut. It's probably one of the furthest away listeners we've had so far.
Yeah.
Says, while it does appear we may be moving out of the bear market, what percentage of liquidity would you recommend I hold in case there is another dip?
Yeah, that's a tough one. It's a really good question. It's probably
good mindset. Good question.
I would say that that's probably the main question for the year, right? Because we didn't know coming into January that all this stuff was going to happen with the pullbacks and, geopolitical issues and whatnot. So generally speaking, when you're doing a modern portfolio theory type of strategy, like what we're doing here at Shepherd Wealth Management, which is just a way to control the asset allocation, the risk that we're going to take to achieve a specific type of result that we're going after over a long course of time. And again, I don't know her time horizon, her goals for the money or any of those things, but generally under most scenarios, you might want to only have 1-2% in cash. But in a year like this, when you got all this volatility, you got to look at the lesser of two evils, right? So liquidity is either cash itself or cash equivalent, like a fixed income product,
right?
Or you have to look to some other alternative asset class and make an investment decision, maybe into something like an equity that you're hoping is going to fluctuate and act more like a fixed income solution during the times that we're in. And I'll talk about that here in just a second. So fixed income. Usually a great place to hang out, specifically when the stock market's as volatile as it has been so far this year. But because rates have been going up here in the United States and around the world, that's a bad thing for bonds. So bonds have also been negative so far year to date. So that's been a losing investment. Cash seems like a better solution, but because inflation's at 8.5%, you're losing every single day that you have cash in an account.
Right.
So before I get to the third solution, here's how we've kind of looked at it from an investment standpoint here at Shepherd Wealth Management. Yes, I understand that certain clients, because of their age, risk tolerance, the goals that they have for their money now, they want to have some stability, and that's generally what fixed income provides. But when we had this conversation of what's the lesser of two evils in this marketplace, well, if we hold on to fixed income, it's a guaranteed loss. If we sit in cash all year, it's also a guaranteed loss. But what we can do is, instead of having that money in fixed income, if we do leave it in cash, let's say we wanted to have 20% in fixed income, but we now have 20% in cash, back in February, March. Now we can look at taking that capital and slowly allocating it into equities throughout the year, right? You're continuously dollar cost averaging into a market that has been, up until recently selling off.
Right.
And if you were doing that all year long, and now you got 4 straight weeks of consecutive positive returns, well, now you might be able to get back to even or even at positive returns faster than somebody that just threw money in the market or left all the positions alone on January 1 and haven't touched them at all.
Right.
Right. We talked about that all year long, dollar cost averaging. The other way that you can do it, and we've kind of taken a combination approach here at Shepherd Wealth Management. We've been using that cash to slowly invest into positions that we feel, whenever the market does fully recover, that are going to benefit substantially from that. So we've done that. But what we've also done is allocate, if we wanted 25% in fixed income under normal circumstances, well, maybe we'll take 5 to 7% of that and let's add it to a sector that we didn't own coming into January, and that was energy. And the rest we left in cash. So now we have kind of the best of both worlds going on this year. We've been using the cash to slowly invest into those positions as the market has sold off. But because we added energy, now we have a sector of the portfolio that's done really, really well this year. And now I can rebalance out of that into other parts of the portfolio. So I think it should be kind of a combination approach. And it's a huge advantage for us here at Shepherd Wealth Management, because I just had a conversation with a colleague of mine, also an advisor, works for a different company, won't mention the name, and they're getting all their performance data, from the first half of the year, and they're coming out and basically sharing with their customers. This is a much larger institution than what Shepherd Wealth Management is at this present time. I mean, not even close. They're basically saying that we don't have the ability to rebalance all this stuff, right? Because we're essentially too big.
Yeah.
So customers have been wanting to take losses, because of all the bad stuff that's happened in the stock market so far this year, so that they can show those losses from a tax standpoint and either use those losses to offset gains this year or in future years.
Right.
Smart strategy, something that we've done here for clients, and we'll continue to do that for clients if the markets give us that opportunity, is taking a loss and offsetting that with future gains. That way we don't have to pay taxes or very little tax.
That's tax loss harvesting.
Tax loss harvesting. They're just basically coming out and saying that they're just too large of an institution to be able to do that for all of their customer base across all of these different custodians that they have, accounts set up with, and it's more than one. So it's a huge advantage. And I've seen that not just with the conversation I had with a coworker of mine, I've seen that happen with other large institutions. And they have their best intentions in mind. Like the right asset allocation is in place. Like I feel confident in saying that. But they're just so large and they want to take out the individual advisor risk that it makes it difficult for them to be nimble in times like this. Like what I just described is using cash to slowly invest in, actually having a different asset class like energy to be able to rebalance out of.
Right.
Well, those other institutions, these really large ones, because they're so big and they want to take out the individual advisor risk, they're going to have the right asset allocation conversation with folks, but that also means you're always going to have a percentage of money in U.S. large cap, small cap, mid cap. You're also going to have X percentage in international, which has been a really difficult place to invest in this year. They're also going to have a certain percentage that's always allocated towards fixed income, right? It's been a tough place to invest this year. We've eliminated the international fixed income for the majority of our clients, and those that wanted a piece of that, they understood the risk, going into it. But we laid it out saying this is kind of what we might expect to happen based on what history has had to say and what the data is sharing with us now. So that's how we approach it. It's much more customizable, and clients really relate to that. That's what they want. Whereas when you have a conversation with a client at a large institution, and they're asking, well, why are we in fixed income when interest rates are going up around the world? And you're just saying, well, because we have to have you in fixed income because everybody else that has a similar risk tolerance as you do is also in fixed income. Like that's a precarious spot to put an advisor in because you're working for the company,
yes,
as well as the customer. But the thing is, like if you have a Series 7 license, and I could spend a whole podcast on this. So I used to have a Series 7, 63, 24. I still have a 66. I have to have that here as a RIA, a Registered Investment Advisory Practice. Like that's the one license I have to have plus my CFP. It's great. But if you have a Series 7 license, you are by definition not a fiduciary because you have to put the employer's interest first. That's your sole mandate, is to produce for the employer.
Yeah.
And the only way that you can get in the industry for most individuals, most people aren't just going to walk into the industry with a college degree and say, I'm going to be a business owner, do all this stuff by myself. Maybe some people have done that successfully. I don't know them, but if you have, hats off to you. Most people go to a larger institution, bank, pick the institution. That's how they kind of get started.
Right.
So that's kind of some behind the scenes, I guess, information for the viewers out there and the listeners out there. I know it wasn't specifically a part of the question here, but I thought it was important to bring up because what she's really asking there is how do I manage my asset allocation and risk in a volatile market? And cash is obviously an asset class that we can use for that. I kind of want to give the full answer of this is what we're doing and this is why we're doing it this way. And it's different than what most other places would be able to do, and simply just because they're just really super large institutions and it's difficult for them to be that nimble. Yeah,
and I don't mean to project this on the question, but it feels like they're asking you how to kind of like get around their own FOMO. Like obviously we've had a couple of good weeks. That doesn't mean in any way that we're out of the woods. And I think maybe a lot of people might expect there to be another small dip. So wanting to be able to maybe take a little more advantage of that dip as opposed to just kind of getting back into like a robust dollar cost averaging, shall I say. I feel like that's what Kat was saying.
I think so, but I think we got a good answer.
Got a good answer, 100%.
If you don't like the answer, just text me back, 513-630-2664, and just tell me how.
Also hit us up on YouTube, Kat. We're really easy to find.
No doubt.
I think we got time for one more question.
We can get a quick one in here.
This is actually, we haven't heard from them in the last episode or two, but Brian from Shelbyville's back. Long-time listener, long-time contributor to the show. Brian's got a question. Do you expect energy to continue its current rollover, or will it rebound?
It's a great question. That's actually been on my mind a lot over the last couple months. I would say this. If we look at the energy space, well, why has it done so well? It's because the demand has been so much greater than the supply. And obviously a lot of that has to do with what's going on over there in Ukraine and, folks not wanting to be able to purchase anything from Russia. And I completely understand that. But there's a huge gap that has to be filled from an agricultural standpoint and from an energy standpoint. And that demand isn't really going to go anywhere as we get... this is why did the energy space kind of pull back here recently? It's simply because as you get closer and closer to the end of summer, people travel a little bit less. There was a whole bunch of fears of a recession, the last couple months, which again, like we've talked about all year long, like who really cares if this is an official recession? It's felt like we've been in a recession all year long for a lot of reasons.
Putting a name on it at this point, it's not going to change the effects of anything.
Exactly. Now, you can't really call a recession because of the tight labor market that we have, like super historically low unemployment rate. And we've never had a recession with that kind of low unemployment rate. We just kind of have all these other issues, right? So why did energy pull back is because people were worried about a recession. And if their fears are correct and there really was a full-blown recession, that people would spend less on things like travel and so forth, right? That was the anticipation that a lot of investors had in the market. Now, to answer the question, what do I think is going to happen? Well, if demand's still greater than supply and we're coming into winter months where people really do need those resources to heat their homes, power their vehicles, their factories, and all this stuff, it's only probably going to come back to where it was. Right? You're probably going to see elevated oil prices. You're probably going to see elevated natural gas prices for the remainder of this year because none of those things are a simple fix, right? You can't just say, hey, Saudi Arabia, do you guys mind producing an extra couple $100 million worth of barrels a day? I mean, obviously they're not going to do that because they like to have the higher price of oil. It's more profitable for them.
Yeah.
Right. I mean, you could say, hey, we're going to go ahead and start doing all these pipelines and so forth to produce more oil and more natural gas. Absolutely. That could solve some problems in the longer term, but in the short term, it's really not going to solve anything.
Well, maybe not even in the longer term because there's that gorilla in the room of the world is shifting to green energy.
Exactly.
So why are these people going to, it's
a tough spot.
Yeah. I mean, the beginning of the year, there was over 5,000 open drilling permits that Biden had approved that weren't being filled because people were reticent to invest in more drilling.
That's just it.
When they might not recoup that investment because people are shifting to green energy.
That's just it. And you can't, who's to say that those things wouldn't be rolled back? Even if they're like, hey, go for it, drill, we'll give you all the political, red tape. We'll just move it out of the way.
Make it as easy as possible.
Yeah, even if they did that, which might solve some short-term problems, could potentially cause some longer-term issues. But even if they did that, it's not like it's just like, oh yeah, now we've fixed the supply problem. We've now got supply equalized with
here's
demand.
Your barrel of oil.
It just doesn't work that fast. So, we're never going to get into a political conversation on this show. Absolutely not. I have my own thoughts and opinions, just like probably everybody else does, about how maybe we could have done some things differently from a agenda standpoint, both with the Fed and in the White House and Congress. Like, I have my own opinions that maybe we could have done some things a little differently. Who knows what the outcome would have been. But the fact of the matter is how could you possibly expect all of these commodities just to all of a sudden, not be anywhere close to as valuable as they are right now when demand is so much greater than supply? It's just simple economics.
Yes.
And I just don't see how that's going to change anytime soon. Now, it will change. And when it does change, you're going to see just as fast as you've seen energy move up and to the right like a hockey stick over the last 2 years, it's going to come back down the other way. So just kind of be prepared for that. If you are a long-term investor, it is an excellent place for diversification during all the things that we're dealing with right now around the globe. But it is not going to be this high-flying sector that's producing all these double-digit gains for infinity. Like we will not have 8.5% inflation. We will be able to get supply to equal demand at some point. I just don't think it's going to happen between now and the end of the year.
Yeah, I would definitely defer to you on that. One thing I can back up with the viewers at home, though, is that Joshua's right. We never do judgments on this show, only an analysis. So we are able to talk about the realities of situations, and we may have a little bit of, enthusiasm in our voice, but that shouldn't lend anyone listening to this now live or on YouTube later that we're advocating for one thing over the other.
And the truth of the matter is
here on the show,
regardless of who takes over the Senate or Congress or the White House, whatever side of the aisle that you land on, historically speaking, as a long-term investor, the market still averages 10%. So from that standpoint, we'll just leave it at that. And last thing that I wanted to share with everybody, and I think you might have something too as to add on top of that, maybe the happy hour show too that we're going to do tomorrow. But I recently got to spend a full day from about 8 a.m. to 5, 6, something like that in the evening in Hazard, Kentucky. And Hazard, Kentucky is eastern part of the Kentucky state, in the mountains. It used to be a heavy coal industry type of environment. Obviously, that's not the case anymore. Right. Very low income levels in general over there. And they were recently impacted by a disastrous flood. And I'm sitting there with people that have lived there for decades, some of their whole life, grandparents, parents, kids, like they've been there generations. And it's just been their home. And they've never had a flood like this before. They've never seen anything like this before. And I got to go there. I got to go with a really good friend of mine. So we spent the whole day there kind of helping with the cleanup. And I'm telling you, it was a kind of a life-changing experience in a lot of different ways. And it took me a long time to kind of reflect on the whole thing because I kind of thought everybody, would just be super depressed. And I'm sure there's a lot of that going on. Obviously, I didn't get a chance to talk to everybody there. But everybody kind of had this attitude of like, yeah, this happened, and this is no fun at all. They're sleeping in this place after it's just been flooded, and there's just garbage everywhere. I saw a bed sheet 40 feet high up into a tree. There are school buses in the river, cars, homes, just devastation everywhere, right? And you walk into a home that's been flooded, if you've never done that before, it doesn't smell very good, right? No. A lot of mold, a lot of mildew. Just everything's wet and muddy, and it's just not a good environment. And they're having to still live in that home while they're going through this cleanup, which is going to take probably years, right? I mean, you've mentioned Katrina. I know that you went to school down there and you spent a lot of time down in Louisiana, and there's still places that are still not recovered.
During Katrina was there.
Yeah, and it was a lot to reflect on, but the attitudes of these people is like, yeah, this happened. This is not fun. But we're going to come out better on the other side. We're not sure how we're going to do it because I guarantee you most of those people probably did not have flood insurance. I didn't have the heart to ask them that directly, like who would want to have that conversation.
Yeah, well, people listening might understand. I mean, Hazard, Kentucky is in the Appalachian Mountains.
Yeah, I mean, you got the mountains.
Ground.
Yeah, and everything flows down. So they said they got 12 inches in a couple hours, 9 inches in 1 hour, something like that. And they just weren't prepared for it at all after living there for as long as they have, just not expecting that. I guarantee you most people probably did not have flood insurance. That's the only thing that would cover something like that.
Right.
It was absolutely heartbreaking, but it was really great to be able to provide some help there. And I want to share with all the watchers and listeners for the program, it is a part of our core values here. So performance, purpose, and passion. Well, performance is a very self-explanatory thing. We're here to produce for clients. We're very passionate about what we do from a skill set standpoint and the services that we provide. But our purpose is to be able to do something more than just make money for other people and be able to support our families here. We're also here to do something good for the global community. And right now in our own backyard, we have a whole bunch of folks that could certainly use some help. So we're here to raise some money. More details to come. About what we're going to be able to do, who we're going to work with to make sure that money goes to the right people that need it the most there. So there's going to be more to come on that, but is something I thought was important to share with all the watchers and listeners here is that's something I experienced, and I want to be able to do something about it.
Yeah, I'm glad you did. And it's one of the reasons, your desire to help and the way that you've constructed this company is one of the reasons why I feel privileged to come and work for you and be on the Shepherd Wealth Management team. For those of you that don't know Josh, don't have the privilege of knowing Joshua personally, he definitely puts his money where his mouth is, and he lives his life the way that he definitely advocates for here on the show. So definitely proud to know you and proud to be a part of this. And the reason why we're announcing it to y'all now, even though it's in the very early stages of planning, is that we just want to get all of the we want to get everyone prepped for that it's coming. So every time we're going to go live, a couple days, we do the daily postings, the little kind of clips from the shows. We pepper them through social media. You're going to start seeing reminders about this fundraiser that's coming. And what we can tell you is that it's going to culminate, at least, we'll probably have donations open for a couple of weeks, but we're going to culminate on one of our happy hour shows, which we've been doing at Pensive Distillery here in Newport, Kentucky, which we love.
Yep.
So please take this opportunity to share the awareness of this fundraiser with your friends. For those of you that haven't had a chance to give, maybe can't go down and help by yourself, tell everyone you know, and just, stay posted towards Joshua and the SWM team. Like I said, we're going to keep announcing it as the plans continue to unfold. So
yeah, appreciate that. So look forward to that, and certainly look forward to the helping those folks out there, because they definitely are going to need it. So it's been a pleasure being able to do this show again. Happy hour tomorrow, right about 4:15 when the market closes. We'll kind of recap the week, what happened, why did it happen, kind of what to look forward to in the next weeks to come. But Ezra, it's been a blast again.
Always
and
a
look
pleasure.
forward to doing this next week. Y'all have a great rest of your day.